now. Okay, I'm recording. Let's continue. It's recording. Where were we? We were still at, I think we were here. I don't know where to put this thing. It's disturbing me. Maybe here. All right. We were at ESA 220. We are saying that what effect will prior significant matters affect our acceptance or continuance with the audit? Mind you, pre-engagement activities are not peculiar to the initial appointment, but it can be done. Pre-engagement activities can also be done on an existing client to see if are we still competent, ethical enough to continue with the assignment, and the client is still has maintained their level of integrity. And also, with regards to significant matters that we've always been reporting, are they taking steps to redress or address those particular issues that were raised by us, not the other auditor? Because it's double-edged now. Pre-engagement activities can be done on the initial appointment, can be done on the existing appointments to see if we are actually within the parameters of our ethical requirements. Our competence is still okay, and the client still has integrity, and all the significant matters that we raised during our audit are actually addressed by management. Right. So before we accept the appointment, we should follow the ESA 220 procedures. We have to look at ethical requirements. You have got to establish terms of engagement. And what is establishing terms of engagement? We agree with the auditors, with the client to say, we are going to be auditing you in accordance with the Companies Act, in accordance with our auditors, in accordance with ESAs, and we are going to be following what we call ethical code of conduct as per IRBA, which is taken from the International Ethical Standard Setting Board, and so on and so forth, because you need to mention your ethical codes that you abide by them as auditors. So what you also talk about the inherent limitation of the audit, that the audit is done on a test basis, and it could actually deal with, fail to address certain issues. Okay, issues of fraud, what is our responsibility? The responsibility of management pertaining to the preparation of financial statements, pertaining to the design and implementation of systems of internal controls, their integrity, and so on and so forth. That you reduce into writing, and the delivery dates as to when we are expected to issue our reports. So, and also your logistics is done there, and also the question of fees, because unpaid fees in accordance with the ethical requirements becomes a loan, and if it becomes a loan, it's an issue of interest, self-interest issues, because there is money that is owed by the entity, and you can't be independent if there is money being owed to you. So you need to know that when are they going to pay, and what steps are you going to take to ensure that they pay. So in those terms, and once we establish those terms, reduce them into writing, and the name changes now. It's called engagement letter. Engagement letter is signed by both the auditor and the auditee, being your client. So when they sign, they agree to the terms as set there. In case there are some conflicts, we go back to engagement letter and say, these are the terms. We set out to do A, B, C, and D. Now you are prohibiting us from doing this, and there is a conflict, and there is a way of resolving that. Maybe you go through arbitration and so on and so forth, but they are not there. So you must know that those terms of engagements are actually reduced into writing. We'll also deal with at some point issues pertaining to what is contained on engagement letter. We have already alluded to most of them, of the issues that are actually contained on the engagement letter. Engagement letter, very important for assessment purposes, you must understand. Initial engagements communicate with the previous auditor. We have alluded to that. You cannot take an assignment without you ensuring that you're showing courtesy to your fellow colleagues, which are your fellow auditors, fellow professional accountants, to say to them, we've been given an appointment by a particular organization. Are there any professional reasons why we should not accept those particular appointments? So professional reasons will be issues pertaining to the auditor will say, yes, there are professional reasons. If there are professional reasons, I'm still reporting an irregularity, that is material irregularity, meaning management have, there is an allegation that they're actually involved in criminal activities in the organization or fraud or something like that. So I'm still reporting that. And if they are reporting that, you don't accept an appointment as an auditor. There are issues that I'm still dealing with, which are of non-compliance with laws and regulations. So you cannot accept the appointment when the auditor is still dealing with those issues. So professional reasons will not be, they still owe me so much. So if they're owing you, it's something else, something different, we should be dealt with somewhere else, but probably not a professional reason. So the auditor should be given that particular platform to communicate with the previous auditor. You do that by requesting that permission from the client. And if the client or the auditee doesn't accept that you communicate with the auditor, then you have to review your relationship with that particular client to see if you can reject or decline the appointment. Because maybe there is something to hide there. Okay. In practice, the auditor needs to address 4 questions with regard to accepting the appointment. The first question that needs to be addressed is, what do you really want to perform this particular audit? Are we happy to be performing this audit? If the answer is yes, you move to the next, which is, if you look at them properly, they're actually the same as what is required by ISQ1, QC1, and ISA 220. Can we perform the audit? Within our firm, do we have those professional competencies to actually perform in that particular industry, to perform an effective audit in accordance with the requirements of international auditing standards? Are we able to do that? So that is part of competence, and part of competence dealing with in our ethics will be your professional competence and due care. Because if you feel you don't have enough staff to be placed in that particular appointment and you don't have any other people to assist you in terms of your networks, you don't accept, simply don't accept this particular assignment and you leave it at that. And the other question that needs to be asked is ethical reason not to accept. Do we have any ethical reason not to accept? I think we've got a dead horse already now when we say ethical reasons have been ethical all the time. I think people now understand when I say ethical reasons. The ethical reasons will be what we did in our chapter 2. Then statutory reason not to accept. Do we have any statutory reason not to accept this particular assignment? The statutory reasons will be we are unable to audit a listed company because we are not part of those auditors who are accredited by the Johannesburg Stock Exchange. That's why we are actually not auditing. We have statutory reasons not to accept this particular assignment. And it ends there. Right, those are the questions that you need to ask as an auditor before accepting an appointment. The next slide deals with importance of documenting the terms of engagement. We have actually dealt with those. Suffice to say that it serves as a contract between the auditor and the auditee. I've alluded to the civil suit if breach of contract. We have also dealt with. So it is very important that the terms should be clear and correct. So also we document through the engagement letter to avoid misunderstanding with regards to responsibilities. If you look at the appendix 1 of IS 220, you'll see that within the engagement letter, the responsibilities of both the auditors and management are clearly stated. Responsible for expressing an opinion on the financial statements. You must allow us unlimited access to the books and records of the company, and you must give us opportunity to inquire from whoever we need information from so that we support our opinion. So an auditor should be given that particular opportunity to do whatever they like in actually arriving at, so that they could arrive at their opinion. Right, so you avoid that particular misunderstanding through documenting them. So what if management does not accept? So if management does not accept, you also decline the appointment because there is no contract actually, because they need to accept their responsibility. So in terms of Section 90 of the Companies Act, auditors are not allowed to prepare financial statements. So once they say no, then you don't need to continue with that particular appointment. As much as we have alluded to the contents of the engagement letter, suffice to look at what is there. You've got your scope. I'm sorry I said it was ISA 220, it's ISA 210, where you have to look at the appendix on your own of the engagement letter. What you need to know at present is that the issues of scope is dealt with, your responsibilities of both management and the auditor is dealt with. Financial reporting framework, I've alluded to that. I've said financial reporting framework could either be RAP, which is your generally recognized accounting principles, and it pertains only to governmental organizations. Then we spoke about IFRS, full IFRS, which is applicable to the listed companies in South Africa, and we've got IFRS for SMEs, which is light IFRS, which is applicable to all the companies that are actually not listed in the Johannesburg Stock Exchange. Those are our financial reporting framework in South Africa. Then the form and content of reports that need to be delivered to the auditee. In this particular instance, we're talking about the audit. So our report will be in terms of ISA 700. That we have audited the financial statements of X and so on and so forth. If you look at that ISA, you'll find that the auditors need to mention that the report will be in accordance with that particular ISA, and the contents of the reports will be in accordance with the ISA, where you've got about five opinions. The first opinion that we have as an auditor will be your unqualified opinion, your qualified opinion, disclaimer of opinion, adverse opinion. I think there are 4 opinions that the auditor can actually give to or grant to the clients or to the auditee. As said before, please look at the engagement letter in Appendix 210. Maybe you have already looked at that. If you have some questions, you can try to answer them now. All right. Any question pertaining to pre-engagement activities? All right. So it means there are no questions. So if there are no questions, we can actually move. When we move to planning. Planning. In planning, you cannot perform an audit unless you understand the organization you are about to audit. So you've got to have a thorough understanding of the organization before you audit. While doing that, you want to reduce your audit risk. We'll see when you continue, and we'll also define what the audit risk is and understand what the organization does in detail now, because you are now moved away from accepting or not accepting. So now it is presumed that you have accepted this particular appointment. So the next step is for you to actually do the planning so that you perform the audit. We've already touched on planning when we're dealing with the audit strategy, giving your scope, giving your timing, and giving direction to our audit. And we've spoken about the planning, the audit plan being more details to actually put meat on these three and giving direction in a more detailed manner in the form of audit programs or audit procedures and the nature, timing, and extent of audit, which is part of your audit approach, right? So your planning will always start with understanding the entity. You have to look at ISA 315 to see what information to obtain, entity, environment, and internal controls. That's what you need to obtain. So you need to have understanding of industry, regulatory, and other factors. The nature of the entity, the selection and application of accounting policies. Very important. The selection and application of accounting policies. So earnings management are done through accounting policies. So we must make sure that the accounting policies that have been implemented and approved by management are actual accounting policies that are in line with what the entity is actually doing. So in most cases, revenue recognition accounting policy is the policy that is of more interest to the auditors, because revenue is significant in the business and they exist because they want to get revenue. So in most cases, revenue is a significant risk in the business. So the risk is twofold. It's either overstatement of sales or understatement of sales for some reason. Both ends will actually provide management with incentive to do both, increasing revenues so that they get their loans and meet their loan covenants, decreasing revenues so that they don't pay VAT, they don't pay tax, they're always on the negative, and they get what we call tax rebates, or not necessarily tax rebates, but they have assessed loss, right? Objectives, strategies, and related business risk of the entity. If they talk about strategy is actually looking at long-term planning of the organization and why do they exist, what are their objectives, what are their values, and from strategy and objectives there comes what we call business risk. So business risk is actually strategic risk in this case, dealing with all those risks pertaining to the peculiar to that particular business and how those risks are managed by the organization. So the next step is the measurement and review of the entity's financial performance. So how do we measure performance? It's risky if you measure performance, for instance, for a salesperson based on sales. They'll just come up with false sales so that they are measured higher and receive their performance bonus, or they meet the performance indicators as set out by management, or other performance targets. So we also have to understand the entity, to look at the entity's internal controls. Internal controls are actually those systems of internal controls implemented by management to ensure the orderly achievement of the company's or the entity's objectives. So it ensures that the objectives of the entity is actually, they are actually achieved in an orderly manner. Those are called internal control, systems of internal controls. Systems of internal controls are seen to be having three elements. First element is that they are detective. They're supposed to be corrective, and they are supposed to be preventative. We'll deal with those three when we are dealing with the systems of internal control, because there is a slide dealing with the systems of internal control. But they must be made to be preventative, meaning they prevent material misstatements from taking place, whether intentional or not intentional. When they are intentional, it's called fraud. When they are unintentional, they are called errors. They must be able to correct them. For instance, you have done something like maybe inputting on computer, you put a number, but once says no, we want an alphanumeric here, not a number. So things like that, those are done to actually prevent errors from happening. Like in the field of identity number, if you put an A, then it will reject. It says, well, I want a number. A is not a number up until you put a number. It's preventing you from actually doing the wrong thing. So it's actually eliminating that, preventing that particular error from happening. Right? That's preventative. Corrective. Corrective, like for instance, in a computer, you type a word and the computer, corrects it to say, no, you mean understood, not understood, like AUNDESTWD. So that's not understood. So the computer will put double O's for you and say, this is what you actually mean. That is corrective. Putting the wrong information and saying, did you mean this? That is actually corrective. We'll make more examples when we're dealing with internal controls. Somewhere else. Okay, we are already there. Aspects of the entity to be understood, the internal controls. So looking at the definition as per ISA 315. So I've already defined the internal control. What is internal controls? And do you have any question with regards to internal controls? All right. The effectiveness of impact auditors' risk assessment of material misstatement. So if the systems of internal controls are so tight that they are preventative, they are corrective, and they are detectives. They can detect a mistake. And when the auditor assesses and they find that the systems are tight, then it will impact on the risk assessment of material misstatements. So there is legally chance that material misstatements can actually occur in that particular organization or in that particular account balance. So lack of effectiveness of internal control systems can actually also impact negatively on the auditor's assessment of risk. So once the controls are not working, you cannot trust the controls. Then if they are untrustworthy or the control risk is high, then the detection risk should be low. We'll come to that as well when we're dealing with responses to risk assessed. So strong internal controls will prevent, detect, and correct misstatements. Detection, when you get into the computer, there are some logs that are happening. When you get into a particular application, they log you to say Zenzel has actually entered such and such a date doing this and this and this. That is actually detecting who's been in the system. Are you? You will find that your banking system also does that. Are you the one who has actually opened your bank system? Just press one. You press one, you confirm that. Then they've detected that there is a person getting into your personal profile in your banking system, and they're asking you, is it you? And you say, yeah, then they've detected that the right person has just entered the system. So material misstatements, because the auditor is concerned about material misstatements, they are less likely to occur in the financial statements if you've got strong internal control systems. So when they talk about design, they talk about the systems of internal controls being designed to prevent. There is a system of internal control that is designed to detect, and there is a system of internal control that is designed to correct. And when you say design, you mean prevent, detect, and correct. That's all. When you talk about implementation, did management implement those systems, even though there are strong systems of internal controls on paper? Were they implemented? If they are not implemented, they're as good as weak, because nothing happened to implement them. And also, the good system of internal controls is also dependent on the control environment. Control environment meaning the attitude of management towards controls. If the attitude of management towards controls is weak, then you actually have what we call an inherent risk is increased, because management do not take internal control systems seriously. They circumvent them at any given point. They bypass them. They're less concerned about the systems of internal control and the orderly manner in which the organization is actually achieving its objectives. So, two things. Design should be prevent, detect, and correct. And if they are strong, they should be implemented strongly as well. And management should ensure that they have good attitude towards, or they set a tone in as far as the implementation of internal controls are concerned. Because an unimplemented strong system is as good as a weak system. Right. We continue with the understanding the system, the client or the entity. So auditors consider internal control, control environment, risk assessment process, information system, control activities, and monitoring of controls. Control environment is your attitude of management towards the controls. If they are setting a good tone from above, then the auditor will see everything. They'll assume that everything is not as bad as they thought, because management are actually setting the tone from the top, ensuring an orderly achievement of or attainment of entities' objectives through reliance on internal systems of internal controls approved by them and implemented by them, by the way. So the next issue to be considered by the auditor will be your risk assessment process. You know that businesses are now looking at their risk in all the processes they are actually involved in. So are they serious about risk assessment? Who assesses their risk? Is the risk management monitored and audited by the internal auditors so that they are effective and efficient in actually addressing risk that are the risk universe that the organization is operating in? Then the auditors will look at that and see if they are taking risk assessment and risk management seriously. Also look at information system. So looking at information system, what controls are there to ensure that the information system, even though under attack, the business will continue to operate even under those particular circumstances. So business continuity policies, auditors will look at that. Control activities, your internal control as well, your detection, prevention, and corrective issues. Are they taking those seriously? And your monitoring of those particular controls. The monitoring is done through the internal audit. They are giving assurance on the effectiveness and adequacy of control activities within an organization or within an entity. So the auditors will look at that to see if we don't have too much inherent risk. We'll define inherent risk at some point. So the auditors also will look at the 4 P's to understand the business. The 4 P's being people, paper, premises, analytical procedure. People, the auditor will go to the organization, talk to the people to understand the organization. The relevant person here will be your CEO, the relevant person will be your financial manager, sit down with them, understand the business from that point of view. Go to the production managers, talk to the production manager, talk to the marketing manager, and so on and so forth to understand the business. And those are people, talk to the workers, talking to the workers to see if there are some issues pertaining to labor unrest and how are they going to deal with, how are they dealing with that, because labor unrest can actually cripple the principle of going concern in the long run. Right? Paper. Looking at the papers that are produced by the entity of strategic planning, you're looking at your internal audit reports and so on and so forth. And outside, you're also looking at the newspaper clips, your industry journals, and so on and so forth. The other manner in which to understand the entities through premises, you visit the place and see what is called the stock. You see who are the workers, who are the employees, how are they actually set up in terms of the grading. Are they harsh in terms of organized labor? You just go there and to the premise and see all those that you want to see. The type of property, plant and equipment that the organization keeps, your machinery, and so on and so forth. Then there is another tool that you need to look at called preliminary analytical procedures. Preliminary analytical procedures. Simple means within the financial statements, you've got a prior year and the current year. You look at the differences and what is causing those variances between the current year and the prior year. For instance, you're looking at 2022 financial year and 2021 financial year. See what is causing if there are some major variances. Talk to management to understand what is causing those variances. Like for instance, recently, all the activities, outside activities involving people were not done. So if you go to marketing, compare marketing in 2019 and 2020, there will be a huge difference in marketing, especially those marketing initiatives that are people related, because we were not allowed to have a certain number of people in the same place. So we find that all those activities were not taking place, and there is a major difference, in fact, a major decline. And you will have to ask the marketing manager what is causing this particular decline, whilst you are doing what we call a preliminary analytical review. They will tell you, no, this is COVID. That's why we didn't utilize this particular account, because this pertains to the people. We needed to gather about 200 people every month. We now, because of COVID, we had some restrictions and we couldn't. And we even transferred those monies to actually ensure that we've got good control as far as capping COVID is concerned. So that is your analytical procedures. Your revenue compared to last year has actually decreased a great deal. What is happening? Have you lost a major client? If so, then you know that there are issues with going concern. You jot that down to say there might be some issues with going concern. So we also have to deal with going concern at some point, but suffice to say that the going concern is actually an ability of a company to pay its debt as and when they occur during the normal business. So that is going concern. So in terms of the standard, the going concern also includes foreseeable future. A foreseeable future is actually regarded as a 12-month period for going concern purposes. Right? Right, we're moving to risk now. Looking at conceptual aspects of risk, and you must understand audit risk. The issue here, when you are an auditor, you are not going to be auditing 100% of all the population. Population means the financial transaction in the general ledger. So you must know you are not going to be doing that. Then you use what we call sampling. When you use sampling, there is an element, there is a risk that you will fail to pick up material transactions and end up giving an inappropriate opinion on the financial statements when the financial statements are actually materially misstated. So also the auditor will apply their professional judgment in the nature and extent of audit tests, or in the nature and extent of audit procedures to be performed. You use your professional judgment. That is, professional judgment for auditors also mean your experience and skills in dealing with audits. So you have a junior clerk will not have the same judgment as a senior partner, because the senior partner has known most of the thing and they've got experience and they will have more professional judgment. In some risky assignments, we'll need a senior partner to make a judgment on certain issues pertaining to an audit. So I've alluded to the fact that an audit is done on a test basis, which is you only deal with sampling in an audit. So sampling that you must get will be a sample that will, in most cases, represent the whole population or representative of the whole population. And there are methods of sampling that are allowed in the auditing environment, and those are dealt with in collecting evidence chapter. So also inherent limitation of an external audit is because it's done on a test basis. And the auditor is concerned now that there might be a risk that I might either over audit or under audit. When I'm under auditing, I'm giving an inappropriate opinion when our financial statements are actually materially misstated. So that risk is that the auditor does not detect all the misstatements that are material. So it follows that we can now define what an audit risk is. It's a risk that an auditor can express an opinion that financial statements are fairly present when they are not fairly presented. So that is that particular risk, and it's called an audit risk. Difference between that audit risk and business risk. I've alluded to business risk. That business risks are those risks that are actually associated with the business and of running a particular business. They are peculiar to the business. An audit risk is the risk that is peculiar to an audit by mainly auditing the financial statements to express an opinion on the material or on the fair presentation of those financial statements. So there are two different risks. That's how you actually differentiate them. So in most cases, the auditor will always reduce an audit risk to an acceptably low level. So they will always try to reduce them, giving an appropriate opinion when the financial statements are actually materially misstated to an acceptable level. And an acceptable level is also a matter of professional judgment by an auditor. And an auditor will always judge what is acceptably low level of an audit risk. So it's not something that you can actually calculate and find out. It's actually measured by an auditor through their experience and skills. So we also differentiate between high risk, low risk engagement, as well as normal risk engagement. High risk engagement, for instance, will be those risks that are actually, that the third parties are dependent on those. So in most cases, all the listed companies audits are regarded as high risk because we've got a lot of investors interested in those financial statements to make particular decisions. You've got shareholders, diverse shareholders categories looking at the financial statements, looking at the audit report so that they take particular actions in terms of investing or not investing in the entity. You will have financial statements being requested by the bank, securing bonds, securing loans and stuff like that. Those entities with those characteristics are also regarded as high risk engagements because third parties, financial institutions, investors, creditors, and so on and so on and so forth are actually reliant on the audit opinion to make particular decisions on those financial statements. Then we come to low risk engagement, which is an opposite of the high risk anyway, but the examples of those will be the owner managed business. They don't want a loan. They only want financial statements or receiver of revenue or SARS to submit to SARS. Then those are taken as low risk. Normal risk or medium risk engagement, anything falling between the two is regarded as medium or normal risk organizations. That's all about the level of risk on engagement. So let us understand the concept of audit risk. So the level of acceptably low audit risk impacts on overall testing, overall level of acceptable misstatement, that is materiality. We'll deal with materiality at the end of the lecture. And I will deal with that and you'll understand why the relationship between audit risk and materiality. So the lower the acceptable level of audit risk, the lower level of acceptable misstatement and vice versa. So in most cases, audit risk would be acceptable at a lower level. So if that happens, your materiality as well will be lower. Materiality means it's a means of measuring misstatements. If they are below the materiality level that has been set, they are regarded as minor and they are not considered for audit purposes because any item is regarded as material when it can change the decision of the financial statements using. If it cannot change, then it's regarded as immaterial. So anything below the materiality level is accepted as immaterial. Bearing in mind that auditors are only concerned about material misstatements. Anything immaterial, they are not really interested. And you will understand that even if items, when you are auditing, you'll find that the differences are immaterial, but they are only immaterial individual. But when segregated, not segregated, in fact, when aggregated, they can be material. And there is a concept of audit differences that the auditor maintains. There is a schedule that to say, okay, in data, we had some differences of so much. And when you add all of them together, maybe they'll be immaterial, or if they remain immaterial, you will just don't qualify the report. If they are immaterial, if they are material, then you have to modify your report accordingly. So what factors affect the level of audit risk in an entity? So in fact, some people call this elements of audit risk. So it's got three components. There is an inherent risk. So this inherent risk is susceptibility of accounts to a risk before considering internal controls. And control risk will be a risk that internal controls of an organization cannot be able to prevent, detect, and correct material misstatements. And then you've got detection risk. Detection risk is auditors, is the risk that the auditor will fail to detect material misstatements during their audit. So in all the three elements, there's only one element that of risk that can be managed by the auditor, which is the detection risk. Detection risk can be controlled by the entity. Inherent risk can only be assessed. Control risk can only be assessed by the entity. Inherent risk is also called built-in risk, meaning this risk is peculiar to the organization, and there are some examples in the book that you need to look at, and they are actually peculiar to the business, and they are without control. Like for instance, if you've got incompetent staff, it increases your inherent risk, and there is nothing really you can do about actually making them competent during the audit. So you must know that for this competent staff, so it means our inherent risk is high, and when the inherent risk is high and the control risk to actually manage those is also high, then your detection risk should be low. So it means to have your detection risk low, you have to audit using substantive procedures, getting more details on account balances to ensure that there are no errors, material errors. And also the materiality will be decreased to a particular a low level. Right? So you also have to ask yourself, what will be the implication if an auditor ends up with higher audit risk than acceptable? So if the auditor ends up with higher audit risk than acceptable, that a risk that an auditor can express an inappropriate opinion when financial statements are materially misstated is still high. So the auditor will have to decline that particular assignment because the audit risk cannot get any lower. The purpose here is to get the audit risk low so that the audit will be able to be confident that the material misstatements have been dealt with. Right? Then, Ebo, are you talking to us? All right, I don't think you are talking to us. Lower audit risk than is acceptable. Lower audit risk than is acceptable means the auditor will over audit, and it's not cost effective to do that. It's not desirable as well. Right, we move to what factors affect the level of audit in an entity. Inherent risk. They've defined the inherent risk. I've also defined it. So inherent risk cannot be controlled or changed by the auditor. Like for instance, I've told you about that incompetent staff. There's nothing you can do about them. So inherent risk factors giving rise to inherent risk, you can go to the book and look at them. They're on page, mine is page 541. You've got your staff competence, staff integrity, complexity of transactions, level of sophistication, age of the information system, design of information system, degree of subjectivity in the determination of figures, and history of the statements. We cannot change that as an auditor, but we can actually work on our detection risk to ensure that we bring about the risk of the audit risk to an acceptable low level, so that we express our opinion accordingly. Right? So you go to page 541 to look at that. Control risk. We've alluded to control risk. Suffice to say that the control risk cannot be changed by the auditor. That failure by the systems of internal controls to prevent, detect, and correct material misstatements cannot be changed by the auditor. But the auditor should be there and be able to assess the systems of internal controls so that they adjust their detection risk accordingly to a lower level. So examples of control risk are also in the book. Look at those factors that are increasing or reducing control risk. Detection risk. which is a tool that is used by the auditor to ensure that the audit doesn't fail. So I've mentioned that detection risk is risk that the auditor's procedures fail to detect material misstatement. Mind you, auditors are dealing with material misstatement, not immaterial misstatement. So that can result in appropriate and adequate audit procedure, which will result in higher detection risk. Our purpose as auditors is to reduce the detection risk, because that's where we've got control, so that our audit risk could be simultaneously reduced. So the auditor has got full control of the detection risk. Right, let's look at relationship between factors that affect risk. Read ISA 200. Risk of material misstatement, a net result of inherent risk and controlled risk result in residual risk. If higher, then higher audit risk. If your inherent risk is high and your controlled risk is high, meaning your inherent risk, people are doing whatever they like, and looking at your control risk, controls cannot detect, prevent, and correct material misstatements, then you've got a higher audit risk. How do you reduce that? There is a mechanism that you need to use, which is detection risk. You need to reduce the detection risk. How do you reduce detection risk? Detection risk you reduce by being more detailed on the account balances, so that you get enough evidence to support what is on those particular balances. So you go more substantive as a way of responding to assessed risk, because you can only assess inherent and controlled risk. So both of them are called assessed risk. So let's continue to look at the relationship. So the auditor must assess inherent risk and controlled risk to determine levels of detection risk. So the model that has been designed to do that, called audit risk model, is audit risk equals to inherent risk multiplied by control risk multiplied by detection risk. Audit risk must always be fixed at acceptably low levels. So it means, because you don't have control on inherent risk and you don't have control on control risk, you only have control on detection risk. You have to push the detection risk to be low, so that your audit risk is also low at the same time. So you need to be more detailed in actually auditing those particular transactions or those particular account balances. How to do that? Go substantive procedures most of the time. Also go for external confirmations. Like for instance, you do debtors secularization, confirm the balances of debtors from debtors as third parties. Confirm creditors' balances direct from creditors as third persons. Confirm bank balances from the banks as third people, and that is called bank confirmation. Confirm all the litigation issues from the company attorneys, direct from them, not from management. So you are reducing that audit risk, at the same time detection risk to an acceptable level. So you've got to consider the risk at financial statements level and also at accession level. So I think you've done the accession level when you were doing your chapter 1. You know what accessions are. So firstly, at financial level, so the risk is actually, the inherent risk will cut across all balances in the financial statements. At accession level, the risk will only be specific to particular account balances, class of transactions, presentation, and disclosure only, not cutting across the whole thing. So in accession level, it's confined to particular transactions within those accessions or within those account balances. At financial statement level, everything is not right, or it's risky. That's the difference between the two. So if you want more examples of the differences between the two levels, you must refer to the examples in the book, right? So now we want to see what will the auditor respond to if inherent risk is high at financial statement level and at assertion level. So we must look at nature, timing of an extent of audit procedures for each assertion, depending on the degree of assessed risk of material misstatement. So in case of inherent risk at assertion level, you look at the assertion and look at all at that particular account balance and look at all the assertions. Assertions will be your valuation, for instance. Let's say you've got debtors, you've got to look at debtors valuation and assess risk pertaining to valuation. Rights and obligation, in fact, it's right. If this data belongs to us, you've got to look at that as well and see if you can reduce your detection risk there. Rights and obligation, disclosure, you've got to look at that, presentation, and so on and so forth. All the assertions pertaining to classification and so forth pertaining to that assertion, which is your debtors or your accounts receivable. You only look at that and come up with audit procedures pertaining only to the debtors and also dealing with that particular assertion that is giving problems to or that is riskier than the others, because maybe valuation will be the ones that will be riskier. Rights maybe it will be riskier and you have to deal with that. Disclosure could be riskier and you have to follow the IFRS in terms of that. Presentation is just the number there on the financial statement, the face of the financial statement. We want to look at that, go to Auditing Fundamentals, page 510. So, going concern. We must look at the risk pertaining to going concern. We have dealt with going concern to say going concern is actually the ability of the entity to pay its debts as and when they occur during the course of business. And the definition per the ISA, per the IFRS is actually different. It also includes what we call foreseeable future. The organization will be able to pay its debt and also realize its assets during the course of its business in the up to the foreseeable future. So financial statements are actually prepared underlying the principle of going concern, that they will continue to operate as business and management have for no intention to actually liquidate the business. Liquidating meaning stopping operations. So if you assess going concern risk, you want to ensure that the entity is actually viable as a going concern. And it's a fundamental principle underlying the preparation of financial statements. Very important. So when you assess going concern issues, you assess in accordance with 3 indicators. There are 3 indicators: financial indicators, there are operating indicators, and there are other indicators. Under other indicators, for instance, we refer to pending litigations, things that are not included as part of financial indicators, for the pending litigation and introduction of a new legislation that will impair the operation of the organization. Financial indicators, we're looking at sustained losses being realized by the organization or the entity. We're looking at the issues of negative liquidity ratios. We're looking at your management accounts showing decline in revenues, operating indicators, loss of a major client, loss of a major supplier of raw material. We're looking at loss of key management personnel. We're looking at loss of skilled employees, and so on and so forth. All issues pertaining to operation, if they are impacting the organization negatively, then we know that there are issues with going concern. So if the auditor finds that there are issues with going concern, management should come up with a plan to mitigate going concern, and they should disclose that such in the financial statements. So in most cases, management, they actually put money, directors or shareholders put money into business. In some cases, all those monies owed by the business to the shareholders, they will agree that we're not taking these monies out of the business up until the business is sustainable or they recover. So if that is the case, then there is an agreement that is signed. It's called subordination agreements with the shareholders. Also, with regards to management plan, what are the plans going forward? The plan should cover a period of 12 months. And when they do that, they should have to disclose what they've done as management, disclose that there are issues with going concern. So going concern is a significant risk, and it's taken as inherent risk. So going concern actually increases the risk of material misstatement at financial statement level, because management has an incentive to falsify revenues, falsify their profit levels, and so on and so forth, to paint a positive picture for the banks or to the investors, so that they actually secure some financial loans to continue operating. So there is a greater possibility of manipulation of amounts and disclosures to show a better picture. So this is done at the assessment of going concern is done at planning level, but a formal going concern assessment will be done at the end of the audit or at the conclusion of the audit to see if really the company or the entity is not a going concern. And if the company is found to be not a going concern, are there any mitigating plans by management to take the company back to its former glory, to be a going concern again? So also, there is a responsibility on the part of the auditor in terms of ISA 240 to look at risk of fraud, because the risk of fraud is taken as a significant risk, and the risk of fraud is actually a fraud is regarded as an intentional error to actually give advantage, unfair advantage to an individual against the organization. So when you are assessing the risk of fraud, you must always say the fraud is always a material error in the financial statement. So there are two types of fraud, of intentional misstatements: fraudulent financial reporting, as well as misappropriation of assets. So the audit procedures that are used to actually deal with issues of fraud is that you have to inquire to management to find out how is fraud taken in the organization. Are there any potential of fraudulent activities taking place in the organization? Any unusual or unexpected relationships when you're doing your analytical reviews, and any other information that can lead to fraud. So you must look also at fraud risk factors. There are fraud risk factors, and there is something called that is used by auditors as well as forensic investigators. It's called a fraud triangle. You're looking at opportunity to commit fraud. You're looking at incentive to commit fraud, and you're looking at rationalization by the organization to commit fraud. And the fourth one, which was not included here, is culpability. Because of my position, I'm able to commit fraud. I can commit fraud, opportunity means the internal controls are so weak that I can actually commit fraud without being caught. And incentive means I'll be better off if I commit fraud than my fellow colleagues. And rationalization is just a stupidity to just put a front that is shown by the fraudster to say, after all, this is not fraud. I'm just taking my money because I'm being paid less in this organization, and management are the ones who are actually taking all the money in the organization. I'm putting my effort and getting nothing. And there is also something called pressure. Financial pressures can lead to fraud. Financial pressure, but pressure at home, your wife wants this, your children want this, and school fees are still unpaid, then you commit fraud to actually deal with the financial pressure. So those are the factors that actually are causing fraudulent activities in the organization. So they are also mentioned that incentive pressure, rationalization. So they are saying that without opportunity, the whole thing, the trimbalage up there cannot happen. So fraud takes place at what level of at financial statement level or at assertion level? Due to inherent risk or control risk, I've actually mentioned that. Fraud actually happens at both assertion and also at financial statement level, because they've got a tendency of actually presenting the financial statements unfairly because of the fact that fraud is actually a significant risk. So if we're looking at revenue recognition, is always deemed to be fraud, to have fraud risk, because management have incentive to either, as alluded to either overstate or understate revenue. If they overstate revenue, maybe in case they want to overstate profits and also acquire certain financial loans or bonds and so on and so forth, or attract creditors or attract other investors. Reduce revenue, falsify revenue by understating it, so that VAT cannot be paid, so that other taxes cannot be paid, because revenue has been actually reduced by management, unfairly so, through fraudulent activity. So management should can also override internal controls through journal entries. So an auditor is interested in all journal entries and adjustments, because one journal entry can actually be taken as affecting the whole financial statements and its inherent risk at financial statement level. It can happen like that. And also accounting estimates. Management can come up with unreasonable estimates so that they manage earnings. We also have to look at significant transactions that happen outside normal course of business. There is an interest in the auditors to look at that, because in most cases, they come up with significant risk. So fraud risk, as alluded to, is significant risk. So you have to adjust your audit procedures accordingly, so that you detect fraudulent activities within the organization. You can do that through analytical reviews and so on and so forth. So special consideration for significant risk. After understanding, identification of risk of material mistake, are any of these risks significant? If they are not significant, you don't have to worry about them. So they are immaterial. So you don't, whatever procedures you use, don't use detailed procedures. So in case of significant risk, you develop specific responses to those particular risks. So also you have to deal with those non-routine and unexpected circumstances, and ESA 315 will deal with the list of factors indicative of significant risk. risks. So you must go through that. And also any fraudulent activities emanating from management is taken as significant risk and should be reported in accordance with the Audit Profession Act. Auditors responsible where risk is significant. Usually this happens on accounts, transactions, disclosure, assertion level, but can be wider. This significant risk. So all significant risks are taken as inherent risk. So there will be some cases where substantive procedures alone could not provide sufficient appropriate audit evidence for an auditor to express an opinion. It happens to some risk of material misstatements. So detective risk alone cannot compensate for high level of inherent and control risk. If so, you must use test of control. So you must couple test of control with substantive procedures whereby you compensate for high level of inherent risk. So here they made an example of pick and pay, where a high volume of sales transactions are processed into different categories. The most important thing here, you won't be doing substantive testing, but you'll be looking at test of controls to see if the system works in accordance with what it was intended for, and rely on those controls. If you find out that the system is actually consistent in allocating sales to different categories. So in case where you find that whatever you do, you're coupling your test of controls and your substantive testing, and still the risk remain high, you modify your opinion accordingly to address those issues where you cannot audit at all. So the auditor will respond to assess the risk in terms of ISA 240 and ISA 330, and they must consider at financial statements the following: professional skepticism. So the auditor should be able to criticize in a professional manner the assertions provided by management. Engagement team. So the auditor, when there are issues of significant risk, must ensure that the engagement team has got the requisite skills and experience to deal with issues of risk peculiar to the client. So they also must consider the nature, timing, and extent of audit procedures. Also engagement supervision. In case where there are high risks of material misstatement, the audit should be supervised closely by senior personnel. Also subject the audit to review process. Ensure that your partners are involved because of their experience. If they are involved in those high-level, high-risk clients, they can actually identify most of the risks that are needed to be dealt with through audit procedures. Unpredictability of the procedures, so that the client will not always expect that we'll be auditing them in a particular way. Also, we must look at accounting policies because they have a tendency of influencing the unfair presentation of financial statements. So how to respond to detection risk at accounts balance classification of transaction and disclosure level? So your detection risk determined for specific accounts or class of accounts or transaction or disclosure. So you've got to consider inherent risk and control risk per assertion, as alluded to before, to determine the required level of detection risk. Detection risk in this particular case, if your inherent risk is high and your control risk is high, your detection risk should be extremely low to actually make the audit safe, or not to decrease your audit risk. So if you want to change the level of detection risk, you have to alter 3 areas of substantive procedures. That is the nature, timing, and extent of planned audit procedures. That is your whole audit approach. You need to change to address issues of assess risk, to decrease your detection risk to an acceptable low level, thus decreasing your audit risk. So your inherent risk, your detection risk, and your control risk, how does those affect one another? So there is an example in the book. If you go through that example, that it says that your audit risk should always be low, but when your detection risk, not when your control risk is low, when your inherent risk is low, you can live with your higher detection risk because everything is working in the client according to plan. So you don't need to be more substantive. So you can accept a higher level of detection risk. Even if you don't detect some issue, there will be no issue because everything is going according to plan. So let us look at 2 audit approaches to respond to risk of material misstatement. So we have alluded to test of control, which is called combined approach. So you're looking at test of controls with limited substantive procedures. Test of controls meaning you are confident that your internal controls are effective, then you are using them with limited substantive testing. So when you do that, you are placing reliance on the internal controls. So all that you are testing is operational effectiveness of those controls. So if you are testing, it will assist you to collaborate or reduce assessment risk of control risk. If that is reduced, then the higher detection risk with substantive testing is justified. So I've mentioned that if you've got a lower control risk and a low or medium inherent risk, then you can accept a higher detection risk with substantive test. Just smaller, reduced substantive test is justifiable because of the assessed risk there. So when the auditor is using a substantive approach, is when the auditor chooses not to or cannot place reliance on internal controls. So in that particular case, you must assume that your control risk is high, therefore reduce detection risk by being more substantive or extensive substantive procedures. So you acquire your audit evidence through substantive procedures that you get more details, more evidence to actually support your opinion. So you must ask yourself as well, which circumstances will the auditor prefer performing test of controls? So you perform test of controls if it is necessary. It is necessary because the internal controls are performing or are assessed to be performing at the required level and the control risk is actually low. If it's possible or feasible to do so, you apply internal control. So now you test of control. If it's necessary to do that, but it's not possible or feasible to do it, then you've got to modify your report accordingly. You can also do test of control if it is desirable for you to do so. So in that particular case, if it's necessary, possible to do, and it's desirable, then you can use performing test of control. This is in practice never done. There is always this combination, which is called combined procedures. So during the audit, the auditor will actually acquire new information and find that the risk is actually higher than was expected at planning phase. Okay, there is a question here that they want to leave for another class. Is that so? Yeah, we'll be leaving at 4. We'll be leaving at 4. I think we are about to finish the whole thing. Our class finishes at 4 anyway. So you need to, in that case, if you've got new evidence, you need to update your audit approach altogether and come up with a new plan. Materiality, I've alluded to the concept of materiality to say anything is taken as material if it can affect the decision of the users. So you only calculate materiality after understanding the entity, assessing inherent and controlled risk at financial statement level, detection risk required at this level, and looking at auditor's response to detection risk. So ISA 320 defines a misstatement if it's material if judgment about materiality is circumstantial, size of the misstatement, and combination of the two. So materiality is determined through the group needs other than the individual needs of individual user. So important characteristics of materialities. We look at individual misstatements against the collective material. I've alluded to the fact that you've got to have that document or that spreadsheet called audit differences, where you get some differences, you put them on, you record them on your audit differences, because individually they might not be material, but when aggregated, they can be material. So you also look at the effect on users' decision making. So materiality is a matter of professional judgment. Mention professional judgment to be experience and skills of the auditor. So materials can either be quantitative, that is, you calculate materiality, and can be qualitative. So if you're looking at quantitative, you're looking at a number that is actually being determined through financial statements and through the certain basis. But if you're looking at qualitative materiality, you're looking at actions by management. If they're stealing money or if they commit fraud, even though materially, quantitatively is lower than your materiality level, you regard that as material. And disclosures, if you don't disclose a particular transaction properly, they are, even though the amounts there are regarded as immaterial, but qualitatively, they are material, non-disclosure of information in a manner that is required by the accounting framework. So there are important characteristics of materiality. User group will be your shareholders, potential investors, debt finders, and groups as alluded to previously. So you need to have steps to calculate or quantification of rent materiality. You use your professional judgment, set of financial statement figures, base components which within the set of figures range for the base, and calculations fall within a particular range. For instance, your financial statements, you base your components on, the component base will be your revenues. You calculate materiality based on the assessed risk to say, okay, this business is risky. You calculate materiality based on the ranges. It would be like for revenue, it would be 1, half is to 1, and that is the range, and calculate within those ranges. How do auditors use materiality in audits? Quantify materiality of potential and detective misstatement. And we also determine significance of financial statement figures or disclosures and extent of substantive procedures. So now there is also performance materiality, because individually accounts can be lower than material, but when aggregated, they can be above materials. So to be able to ensure that you are staying within materiality, you use what is called performance materiality. Performance materiality is actually based on the materiality levels that has been calculated, that is your planning materiality. Take a particular percentage based on a professional judgment to be used as to judge the materiality on each account balance. And also there is a clearly trivial issues where even if you can combine them or you can aggregate them, they will never be material. Then they are called trivial. Once you see a trivial issue, you don't deal with it altogether, you leave it like that because it is trivial. It will never reach a stage where it becomes material at any event. That's how you calculate your materiality. So materiality, it's very important class. You need to understand materiality fully and how to calculate it, and the basis of materiality and how to calculate materiality using those particular base. You can get it. In fact, you will get a question on materiality in your examination, because materiality is very important in the audit. You compare your materiality or juxtapose it against your assessed risk. So if your risk is being assessed high, to push your detection risk to a low level, your materiality level should be as low as possible to allow for the auditing or review of a lot or many accounts. Right. I think that is the end of our lecture for today. We're still on time. We've got 1 minute. Any question? If you don't have a question because you are running to another lecture, you can send me some questions on my email, or we can consult with me. But most of the questions will be answered by your tutors there. I thank you very much, class, for being patient and waiting until the end of the class. Have a great day further. Bye.